Hello, hope everyone is doing great. In today's video, we will discuss a huge question. Can you really beat the market? We will take a closer look at the efficient market hypothesis, the idea that markets are so efficient that it's nearly impossible to outsmart them. But is that true? Alright, so what's the goal here? First, we're going to break down the efficient market hypothesis, what it really means. Then, we will test if it's even possible to consistently beat the market. And finally, we will take a look at some real stock data and use RStudio to test these theories ourselves. Before we dive into the experimenting and results, let's first take a moment to go over the key concepts we'll be exploring. We have market efficiency. This concept is at the core of EMH. It refers to how well market prices reflect all available information. In an efficient market, stock prices should always incorporate all publicly and privately available information at any given moment. The idea is that prices adjust immediately to new data, so there's no room for systematic profit from trading on that information. Information availability refers to the fact that all information, whether it's publicly available news or private insider data, is accessible to everyone in an efficient market. The more quickly and widely information spreads, the more accurate and fair the prices will be. In an ideal efficient market, no one has an informational advantage, and everyone makes decisions based on the same facts. The random walk theory suggests that stock prices move in a random, unpredictable manner. If the market is efficient, the price changes are driven by new, unpredictable information, which makes it impossible to forecast future prices based on past trends. Essentially, it's the idea that the market behaves like a random walk, where future steps can't be predicted from the past. Lastly, we have market price adjustments. As new information becomes available, whether it's earning reports, news events, or even rumors, prices adjust instantly to reflect this data. This is crucial because it means that no matter what information you have, the market will quickly absorb it and adjust prices accordingly. So even if you have insider knowledge, in an efficient market, that information should be already priced in. Now, let's see what the EMH is. Think about it. You are not the only one analyzing stocks. There are thousands of analysts, traders, bots, institutions, all watching the same data and reacting in milliseconds. That's what the efficient market hypothesis says. Prices already reflect everything that's known. Earnings reports, breaking news, rate decisions, even rumors. It's all instantly absorbed by the market. So when you think you have found an opportunity, ask yourself, do you really think you're the first one to see it? Chances are the market already reacted. The price already moved. The EMH tells us, if markets are truly efficient, no one can constantly beat them. There's no magic strategy, no hidden pattern, just randomness. And when someone does outperform, maybe it's not a skill, maybe it's just luck. Let's begin by testing the idea behind the efficient market hypothesis. This time, we will use a well-known stock, Apple. If we can predict future price movements based on past performance, that will suggest we could consistently beat the market. However, according to the efficient market hypothesis, this shouldn't be possible because the stock prices should move randomly, reflecting all available information. So we ran the Dickey-Fuller test on the log returns of Apple. The result? A p-value of 0.01. What does this mean? It tells us that the returns of Apple stock are stationary, meaning that they don't follow a predictable pattern over time, and that the price movements fluctuate around an average. So why is this important? According to the EMH, prices move randomly, and we should not be able to predict the future movements. The p-value of 0.01 confirms that Apple stock returns are stationary, which means that the market is efficient and there is no way to predict future prices with certainty based on historical data. This result tells us that even with a stock like Apple, which many investors try to outperform, the market behavior remains unpredictable, just like the EMH suggests. I encourage you to try this test on any stock you're interested in, run the Dickey-Fuller test and see what results you get. It's a great way to test if the market is really as efficient as it seems. Let's put it to the test again, this time using something called autocorrelation. If past returns could help predict future ones, we would expect to see some structure here. So we ran this test on Apple stock to find out. Here are the results of the test. We plotted the ACF of Apple daily log returns. At lag 0, as expected, the value is 1. That's just the return being perfectly correlated with itself. Beyond that, the values fluctuate between minus 0.07 and 0.05. Only a couple of lags like lag 8 and lag 9 stand out a bit, but even then, they are barely outside the confidence bands. The rest are all inside the range with no clear structure or pattern. So what does this mean? There's no strong autocorrelation. The returns look random, and randomness is exactly what the efficient market hypothesis expects. Try this on any stock. If markets are efficient, you will find the same. Now, let's look at one last experiment, comparing two portfolios built in different ways. In the first simulation, I created 20,000 random portfolios using 7 randomly picked stocks. So, some of them did better than the S&P 500 15.22% annual return, but most didn't. The average return was 8.9% and the distribution was pushed to the left, meaning most ended up below the market. Then I tried again, but this time using just 3 popular companies, Apple, Google, and Microsoft. The average return was 16.05%, just a bit higher than the S&P 500. But here's the thing, I chose those 3 because I already knew they have done well recently. That's using past performance, and it doesn't guarantee future results, and even then, the extra return was very small. So this doesn't disprove the efficient market hypothesis, it actually supports it. Using past data to try to beat the market isn't a reliable strategy, and most of the time, the market wins. Now, let's move on to the other side of the coin, the criticisms of the efficient market hypothesis. There are a couple of important points that suggest the theory doesn't always hold up in the real world. First, we have the behavioral biases. The idea here is that investors don't always make rational decisions. In fact, emotions like fear, greed, and overconfidence often drive stock prices. This leads to mispricing of stocks because the market is not just reflecting available information, it's also reflecting human emotions. For example, during market panics, stock prices can drop much more than they should, and during periods of optimism, stocks can become overvalued. This shows us that the market can sometimes be inefficient. Next, let's talk about market anomalies. There are patterns in the market that don't fit the predictions of EMH. One well-known example is the January effect, where stock prices tend to rise more in January compared to other months. According to EMH, this shouldn't happen because if the market were truly efficient, stock prices will reflect all information and will not follow predictable seasonal patterns. The fact that these anomalies exist suggests that markets don't always behave as EMH expects. So while it's a helpful theory for understanding market behavior, it doesn't always explain how the market behaves in practice. The presence of human biases and market anomalies shows us that the market efficiency isn't perfect. So now, after diving into the different experiments, we've seen the reality of trying to beat the market. While EMH suggests it's nearly impossible, our tests show that at times, we can slightly outperform, but it's not a guarantee. The market is tough, and even with the best stocks, it's all about the timing, luck, and of course, random chance. So we have seen some portfolios underperform and others do slightly better, but it's all part of the bigger picture. At the end of the day, even the smartest strategies may not always work. It's like playing a game where the rules keep changing. The stock market is unpredictable, and while we try to make sense of it, the reality is it's not just that easy. So to wrap it up, here's the big question. Can you truly beat the market?